Contrary to common belief, the stock market is not only a place for Wall Street gurus and financial whizzes. Indeed, it's a field where even a common person like you and me can make a fortune. Take the story of Mohnish Pabrai, for instance, who completely obliterated market expectations by earning a whopping 1,204% return. And mind you, he's not a Wall Street wolf, but just a regular guy with an extraordinary understanding of the market. Let's break this down further. How did Mohnish Pabrai destroy the market by 1,204%? So, subscribe to the channel and stay tuned. Any investor should first question the complexity of buying a stock prior to purchasing a share. This matter takes precedence, even before considering the price or any other factors. It's vital to understand that buying stocks isn't as simple as it appears. Additionally, it's interesting to note how the evolution of the market has influenced this activity. The process is performed mostly on digital platforms such as smartphones, tablets, or laptops as we navigate the modern age. However, just because it's performed on a simple device doesn't necessarily mean the activity itself is simple. The truth is, it's quite a complicated undertaking. Therefore, it's crucial for anyone interested in investing to be aware of this before diving into the stock market. This will ensure they are well prepared and can make informed decisions for a successful investment journey. In a recent interview, investment guru Mohnish Pabrai emphasized how buying or selling stocks from various companies is extremely simple. There's virtually no effort required to do either. Nevertheless, suppose one wants to truly do well in it. In that case, a deeper understanding of the business behind the stock is crucial. Furthermore, it's important to have your own perspective on the company's current market value. To give you a clearer picture, Pabrai draws from his personal experiences. Quite often, while at his local health club, a fellow member might ask him, "Mohnish, should I invest in Apple?" His response is usually to challenge them back and ask, "Do you know Apple's market capitalization?" Normally, people are stumped by this and revert to the current stock price as their answer. He corrects them by insisting on the importance of knowing the market capitalization. Pabrai explains that this is akin to buying groceries in the market. If you're buying rice, you would know the price per kilogram, wouldn't you? Similarly, before you decide to buy a stock, you should at least have an idea of what the entire company is worth. Unfortunately, this basic knowledge eludes most investors, which is quite surprising. According to Pabrai, the first significant question an investor needs to ponder before buying a stock, even before considering its price, is whether or not they understand the business well enough. In essence, is the investment within their area of expertise or circle of competence, as he poetically puts it? He believes this is the key to making smart and informed investment decisions. The idea of a circle of competence is immensely vital, especially in investing. This concept is paramount, even to prominent investors like Warren Buffett. Interestingly enough, almost 95% of stock options are beyond Buffett's circle of competence. This means that, to him, these stocks are too intricate to comprehend or simply don't reside within his area of expertise. Almost 97 to 98% of investment opportunities available to him are often dismissed and placed in a box labeled too difficult to understand. In other words, he determines that the complexity of the investment surpasses his comprehension. Consequently, only a tiny fraction of available businesses pass this rigorous screening process. Suppose an exceptionally successful investor like Warren Buffett finds it challenging to grasp the nuances of 95% of businesses for the average person. In that case, this figure is probably closer to 99%. That suggests that most investment opportunities will be deemed too complex and, hence, fall outside most individuals' circle of competence. Let's imagine a scenario in which a potential investor successfully responds to a question. Mohnish concurs that the investor comprehends the entirety of a company like Apple and that it falls within their area of expertise or circle of competence. Following this, another query comes into play. It's rather direct, asking what one would be willing to pay to acquire the company. An important question that every investor should pose themselves follows next. Assume the investor acknowledges that a company like Apple could be valued at $1 trillion. A subsequent question to consider would be, if one's family had amassed a fortune worth $4 trillion, would they be open to investing a quarter of that fortune, a sizable chunk, into Apple? The answer to this question determines the next course of action. If the response is affirmative, they should purchase the stock. However, they should avoid buying even a single share if the answer is negative. These steps might seem simple, but they are crucial in investing. It's all about assessing one's total net worth, understanding one's family's wealth, and deciding whether one would be willing to invest a quarter of it in buying a company they are considering getting 100 shares. Unfortunately, these fundamental aspects don't seem to get the attention they deserve from most investors. Therefore, realizing these things, understanding what a stock is valued at, and identifying one's circle of competence when it comes to investing is essential for anyone wanting to make informed investment decisions. These concepts might seem a bit complex, but when Mohnish Pabrai speaks, it's best if we all tune in. For most people looking to invest their money, Mohnish suggests going for indexing. This means investing in something like the Nifty 50 index or any broad index in India. Why? Because the charges you pay for ETFs and such are quite low. It is a pocket-friendly option. Moreover, you can make an average over time. When your salary comes in each month, set aside a little bit, invest it in these funds, and then stop worrying about it. Mohnish's advice is simple. Set it up, then forget about it. So, buying individual stocks should be more of an exception than the rule. Moving on to the next topic, Mohnish shared some interesting insights about the idea of a stop loss. It's a concept that's quite popular in India but seemingly unheard of in the US. In India's investment world, many technical experts are even required to stop losses. But these people are usually not concerned with the fundamentals of investing. They're more interested in studying financial charts. But what does Mohnish think about this? He believes that serious investors shouldn't rely on stopping losses. They don't usually talk about stop losses, but it seems to be a frequent topic amongst those who emphasize the fundamentals of investing. It's crucial to note that we're not discussing speculators and traders here, but investors. Mohnish Pabrai shares an analogy about the stock market's unpredictable nature by referencing the real estate market. He talks about the scenario where you buy an apartment in Mumbai for 1 crore. After purchasing, you engage the services of a real estate broker's services to keep track of your apartment's daily price fluctuations. Despite daily updates, the price may only vary slightly over a year. Contrastingly, if the same apartment was a company listed on the Bombay Stock Exchange and its daily price changes were recorded, the result would be much different. The value could fluctuate widely between 70 lakhs and 1.3 crores. This is because auction-driven markets like the stock market are prone to both understating and overstating actual value. This flux creates opportunities for savvy investors. Pabrai goes on to address the concept of stop losses in investing. Using the same flat analogy, he says that selling your apartment when its value drops slightly isn't logical, especially when you've deemed the purchase price fair and plan to hold on to the asset long term. The same principle applies to stocks. If you bought stock at 200 rupees with a 1,000 crore market cap because you believed it was worth 2,000 crore, you wouldn't sell it just because its value dropped to 900 crore. Pabrai argues that investors should focus on stocks that fall within their circle of competence, meaning they understand the business and believe its market value is higher than the current valuation. Pabrai also suggests that while identifying and investing in bargain stocks can bring profit, investing in growing companies is often more beneficial. However, selling stocks can be a complicated decision, even more so than buying. When a stock appreciates in price and seems fully priced, the investor must decide whether to sell or hold on for potentially more profit, especially if the company still shows signs of growth. Pabrai advises selling stock not when it's fully priced or overpriced, but when its value is egregiously high. Hence, investing is not just about buying stocks and hoping for the best. It requires a deep understanding of one's own financial situation, the company being considered, and market trends. If you liked this video, don't forget to hit the like button and subscribe to our channel for more insightful content.